Today, we're diving deep into an energy giant, Halliburton. We're going to tear through the financials to answer one big question. What's this company actually worth? Let's jump right in. So here it is on paper, Halliburton. It's a huge company, a real pillar of the energy world. You see the stock ticker, the basic stats. It's a pretty familiar sight if you follow the markets at all. But that's just the surface, right? And it leads us straight to the big question, the whole reason we're here. Forget the day-to-day stock jumps. What is the real fundamental value of this business? Well, that's exactly what we're about to figure out.
All right, first things first. Before we crunch any numbers, let's get to know the company we're looking at. So who exactly is Halliburton?
Okay, so Halliburton is an absolute beast in the energy world. We're talking about a company that's been around since 1919, and they don't just, poke holes in the ground for oil. No, they're the brains and the brawn behind it all, providing the super high-tech gear and services that make the whole energy industry tick. You could almost think of them as the indispensable pit crew for the entire sector. All right, we know who they are. Now let's check their financial pulse. We're going to start with the big headline numbers, to get a first impression of the company's health. So first up is the market cap. We're looking at almost $23 billion. Think of that as the stock market's current price tag for the whole shebang. It's our starting point, our baseline, before we really start digging in.
And check this out, the sheer size of their business. Over the past year, Halliburton has raked in more than $22 billion in revenue. That is a massive top-line number, and it's the foundation for everything else we're going to look at.
Okay, let's talk about a classic, the PE ratio. At around 18, it's basically saying that for every $1 Halliburton earns, investors are willing to pay $18 for the stock. This is really our first big clue about the market's mood towards this company. But one number is never the whole story, right? So let's look at a few others. The forward PE is way down at about 12.5. That tells you that analysts think earnings are going to grow, which makes the stock look cheaper down the road. Then you've got price to sales at just over 1. Basically, you're paying $1 for $1 of sales. And price to book shows the stock is trading for a little more than double the company's net assets. See? When you put them all together, you start to get a much richer picture of what's going on. So, the big question is, how good is Halliburton at actually making money from all those sales? Well, a net profit margin of almost 6% is pretty decent, and a return on equity of nearly 13% is solid. But wait a second. Here's our first little mystery. The revenue actually went down a bit over the last year. That's definitely something we need to dig into. In that little dip in revenue, that's our cue to go deeper. It's time to pop the hood and really analyze the company's core financial statements. Okay, so we're going to be looking at what I call the 3 pillars of a company's financial health. First, the income statement. That's all about, are they making a profit? Second, the balance sheet. That's what do they own versus what do they owe? And third, the cash flow statement, which is maybe the most important. Where is the cash actually coming from and going to? So let's start with that income statement. Remember that little dip in revenue we saw? Well, here's the context. If you zoom out and look at the trend from 2021 to 2023, it's a completely different story. It's a story of really strong growth. Just look at it. Revenue, gross profit, and especially net income, they're all marching steadily upwards. Now let's flip over to the balance sheet. And guess what? The story here is just as good, if not better. Total assets are going up. The company's net worth, its equity, is growing. And this is the best part, their total debt is actually going down. I mean, you can't ask for a better sign. The company is getting stronger and relying less on debt. Last but not least, let's follow the cash. Because remember, profit on paper is one thing, but cold, hard cash is king. And what we see here, wow, it's incredibly healthy. There's this huge upward surge in the actual cash the business is bringing in. We're talking both from its day-to-day operations and the free cash flow left over after everything's paid for. That's a beautiful sight. Okay, so we've seen all this really positive financial data. Now it's time for the main event. We're going to take all these numbers and plug them into a financial model to come up with our very own estimate of what Halliburton is truly worth. And the tool for the job is a DCF, or discounted cash flow model. Don't let the name scare you. All it does is try to predict how much cash a company will make in the future, and then it pulls that value back to today. Because $1 tomorrow isn't worth as much as $1 in your hand right now, right? It's like using a crystal ball for finance.
Of course, that crystal ball isn't perfect. Nobody can predict the future with 100% certainty. So, to cover our bases, we're going to look at 3 different scenarios: a pessimistic bear case if things go wrong, a reasonable base case, and an optimistic bull case if everything goes right. And here are the numbers. In our worst case scenario, the stock is worth about $45. In our best case, everything is awesome scenario, it shoots up to 70. But the one we're really focused on, our most likely middle of the road estimate, is that base case, and it comes in right at $52 a share.
Let's just put that number front and center, because this is it. This is the big takeaway from our number crunching. Based on all its future potential, our model says the true intrinsic value of Halliburton is $52 per share.
So, we've got our number, $52. Now for the final showdown. Let's see how our value compares to what the stock is actually selling for on the market.
And here it is. This is the punchline of this entire deep dive. Our model says the company is worth $52 a share. But when we ran this analysis, the market was selling it for just $27.30. I mean, that's not just a gap, that is a chasm, a huge disconnect.
So the conclusion from the analysis is pretty blunt and to the point. The DCF model is basically screaming that this stock is undervalued at its current price. And that leaves us with one last really interesting question to chew on. We've seen the financials getting stronger, we've seen the cash pouring in, and we've got a model that points to a massive discount. So what do you think? Is Halliburton just a classic old-school value stock that everyone's overlooking? Or is there something else going on, something the market sees that we don't? That's the real puzzle here.